Are you on?
On? Microphone? Okay.
They're having such a good time. Maybe we
I
just
know.
leave them.
Okay. Sorry to interrupt these great conversations. Not that sorry, because I'm interrupting it to have a conversation with Bob Merton, who needs no introduction to all of you. Very exciting to have him here after having worked for the last 2 days on the exciting theme of the 50th anniversary of Black-Scholes Merton. But as some of you heard me say yesterday, this topic is particularly appropriate for having Bob here because not only did he invent an options pricing formula that has had great impact in the private sector, but he just right away, probably at the very beginning, saw the applications and importance for contingent claims in the public sector. So can't think of anyone better to talk about these issues with me. And but what we thought would be a good idea is Bob prepared a few slides he wanted to talk through, which are really, they're nice. That's how he thinks through framing the issues. So Bob is going to start by presenting some slides, and then we'll have a bit of a conversation, and then we're going to open it up for everyone's questions.
Okay. I'm sorry to interrupt your conversation. It sounded pretty interesting when you were talking. But about these slides, probably most or any of you know what I'm going to show you. But it's, for the whole conversation, if you don't see the connection between options and what we've been talking about this morning and so forth and these contingent liabilities, it's going to be like I'm talking in a foreign language. So if you bear with me, those that already know it, I just want to run through it quickly. This is my speed credit risk class. It lasts about 10 minutes. So we'll get into it. So to get started, let me just start here. In this hand, I have a mortgage, a loan, a bond, okay? In dollars, US dollars. In this hand, I have a full faith and credit US government guarantee. If I staple them together, functionally, what do I have? Leave aside taxes and collateral. It's a risk-free asset, right? It's just like a government bond. So therefore, if I then rip the guarantee off, what do I have? I had a risk-free government US full faith and credit treasury minus a guarantee. So that loan, that mortgage, that bond is simply a risk-free bond, government bond, we all understand that one, minus a guarantee. Now, what is the guarantee and what is structure? I hope you can see the slides. I barely can, but that's okay. I think I know them. And if you look up there, what I just did physically, you can see are the first two lines. So functionally, we know that whenever you buy any debt claim for which is not risk-free, you're in two activities. You're lending money risk-free and you're writing insurance. You're writing a guarantee. You're in the guarantee writing business, which is an honorable business, and insurance has been around longer than finance, but you ought to know what business you're in. And how much of those two different businesses depends on the relative riskiness or characteristics or value, if you like, of those two pieces. But it's very important to understand, it's very common, with corporate, with risky bonds to just add a spread to it and say, well, I get an extra 1%. Well, that's just like, you have to understand the kind of risk you're taking. That's why I go through this. Now, what is the guarantee? Well, ask the question. If you buy that bond without the guarantee, what do you get when the payment's due? You either get what's promised, let's say $1 billion, or one way or another, frictions and everything, you end up with the assets. And the assets are always going to be less than the $1 billion because otherwise they would have paid you, okay? So you're going to get one or the other. And if you had the guarantee, though, if you get paid what's your promise, the guarantee turned out to be worthless. Like most insurance policies. In fact, most of us hope that the things we insure do end up being worthless. We don't use them, okay? So this is not anything unusual. On the other hand, if there is a default, then what you get is what was promised minus what you could have recovered. So the payoff to that is the maximum of 0, or B, the $1 billion you were promised minus the value of the collateral assets. Well, I hope you all recognize that payoff function is a put option. And the strike price is what's promised. The asset which is having a put option on it is what? It's the collateral that's pledged for that contract, whether it's a house in a household or corporate assets or whatever they are. Or if it's a bank, it's the bank assets, okay, that if if it's a bank guarantee. So what we see is, one, we know it's put options. So if you never heard of credit before, if you learned options, you already know an awful lot about the structure of how credit changes its risk, its properties, the shape of the curve of its value, how, so you're already way ahead of the curve. And we only took, I think, 3 minutes for that one. So we got you there, it's that far. So that's all I wanted you to see from that. Next, I want to show you that the fact that, one of the most insidious things, credit risk sometimes looks very simple, it's like a risk-free bond, but with some risk, so you get a little extra credit. But what's not appreciated and understanding is the risk characteristics of the guarantee. Now, I mean, the left side graph is the actual bond or loans value, but that's just the risk-free bond minus the guarantee. So the next line, I don't think I can even point it. Matt couldn't get it done, so I don't think I will in terms of this pointer. So if you look at the middle one, that's the guarantee. That's where the juice is, the action of what's happening, okay? And if you look at that curve, it looks like a put option. What do you notice about the value of the put option as a function of the value of the collateral assets? It's not a straight line. It's not linear. In fact, it's convex. It holds water, all right? So what does that tell you? Well, you can see from the picture, when you're at point A in assets, there's a certain value to the guarantee, right? But you'll notice at that point, there's a slope to that curve. And as you all know, or I hope you all are aware of, if you look at that slope, for small movements anyway, that tells you how sensitive the value of that guarantee and therefore the value of that bond is to movements in the assets. So it's a negative slope, but that's just look at the magnitude. Now, if the assets fall to A prime, of course, the value of the guarantee goes up, the value of the bond goes down. That's not surprising. If you've insured something and, the amount of assets that are there had gone down, it's worth more. That is pretty intuitive. What I don't think is people appreciate, unless they've been through the exercise, is how the risk changes. At point A, look at that slope just for a small move. Small changes might have an absolute value of 0.02. So like for $1 movement in the collateral assets, you get a 2-cent move in the value of the guarantee, and therefore a 2-cent move in the value of the bond. But now, if you go to A prime, you're still in the game, right? You don't play the game once, all right? Well, you see that your asset is worth less, or the guarantee is worth more, whichever way you want to look at it. Your liability, if you're writing the guarantee, is more. But what else do you see? The slope is steeper. What does that tell you? Same shock, again, instead of 2 cents, it could be 4 cents or 5 cents. Or, as we saw in 2008, if you go through a series of these that happen in the real world, especially with structured products, okay, which we won't go off into, but those risks can change by many orders of magnitude. That's what I want you to see. So people who look at historical data on how sensitive a particular loan bond or something was to the assets, and they use historical, let's say regression or anything historical, if the world changed, which it does, you see that's the wrong number. And I believe that's part of the reason you get these stories. You remember 10 sigma event? The reporters would go to Goldman Sachs and say, how likely is a 10 sigma event? And they say, and then they say, well, we had 3 of them in the last week. Part of that is, even if you had a 2 sigma event in the actual assets, if you use the wrong slope, if you use the flatter slope, it looks like it's a much bigger move. So all I want to alert everybody to, that the thing about credit and guarantees that's particularly complex is it's nonlinear, and in times of change, relative to each other, the value can change dramatically. This is not, a few basis points, whatever kind of thing. This is a big movement, and that's the message here. Now, that's for the loan itself, let's say to a mortgage, but the banks are the ones making the loans, right? So the banks own the loans or mortgages, they're writing guarantees of those assets. You see from the first slide. So let's look at not the risk of the asset to the bank, the middle slide. Let's look at the government guarantee of the bank assets. The government is guaranteeing the bank assets. What are bank assets? They're risk-free assets minus guarantees of the actual physical assets, houses or whatever. So they're writing a guarantee of a guarantee. They're creating a convex function of a convex function. That's very convex. So those of you who are thinking of how quickly the risk can change, you see that for the government, or if it's the government, it's the guarantor of the banks, that actually the risk can change even more dramatically for a given change in the asset values. So I just want to sensitize you to that these are not small numbers and that the convexity can be really bad. And in 2008, and people like Ben could tell you for real, but when you have 2 or 3 of these shocks, and you have that amount of money, the risk factor can go up by multiples. And that's something to always be sensitive. So any of these things that look at historical regressions or, what happened, they're out of the game. This is all assuming that the risk of the assets are not changing. Of course they are. But I'm trying to say this is structural. Even if you could believe that everything had, that the assets had constant, log normal distributions or something, you get this effect. In the real world, of course, the volatility is changing and you know which way that's going. So that's what I wanted to sensitize you to here. Okay, so I hope that gets your attention that this is not, but I hope it also did. Now, to underscore it, I look back at COVID and I took 8 companies that you'll recognize who they are. None of them are banks, I don't think. Citibank's there, I guess. Isn't it? Or maybe not. Yeah, Citigroup's there. But 7 of them are, they're corporate firms. They're non-financial banks. And the names you all recognize. They aren't some things. And these are actual corporate bonds. These are market prices, okay, for corporate bonds. Now, I remind you that the corporate bond market is not the Mimi market. This isn't where people are trading, sitting, around a table like this, telling stories to one another, and let's run up to do these things. This is a very professional market. These are institutional markets. That doesn't mean that they can't get mistakes, but let's just be clear. This is not some little, GameStop type market. This is for real. And look at the price of the insurance, the guarantee, the market price. How did I get that? I took treasuries, price to promise payments, and subtracted the market price. That gives me the guarantee. That model is robust. I didn't say it's a log normal distribution or anything. So I just want to remind you, that's why I showed you the first slide. So this is not particularly on a given guarantee. If you look at the first column, you can see in August 2019, before COVID, there are the prices for guarantees. By, I think it was, the actual date I think is February, is April. April was not the bottom. Okay. March, I think it was the 26th. It's also when the VIX hit 80 something, the first, for those who follow the fear index or something. In April, you can see that the price had changed a little bit in that 6 months. Look at Delta, not surprising given COVID, okay? But look at Apple, look at, all of them. Orders of magnitude change. Now, look at August of 2020. Another, just 6 months down the road. Let's go back and look at them and compare the last column with the first column. I mean, the middle column, you can see that what's happened with the rates, they went like this, right? I mean, but compare the first and the last. 5 of the 8 are lower in August of 2020 than they were before COVID. 3 are higher than they were before COVID, and probably for good reason. I mean, for good reasons. So I put this up there to try to bring home that not just theory of those slides where I was showing you how the things moved and the risk changed and the value changed, to show you here's market valuations of very straightforward types of credit, nothing exotic, and so forth, to give you an idea of how much, especially in times of a crisis, which COVID, of course, was, how much these can move in terms of value. And by the way, they can also go back. So, you have some people saying, oh, by August, those myopic investors had forgotten all the bad things that happened in April and March. And so now they were willing to insure at a rate that was, as if it never happened. Well, that happens to be the case what happened ex post. But, that's a perfectly rational thing to have happen. And that's what the test is. So with that, let me then move on a little. I know I'm taking a little more time. Now, you've seen the structure of the risk and how quickly it can change and all that sort of thing. And that's what. Now I want to point out some further dynamic complications that appear on the issues that came up, some I believe this morning, but in general come up when we talk about financial stability, is where you have a guarantor being guaranteed by the entity that was being guarantor. It's a tongue twister. I never get it quite right, but you get the picture, okay? And you say, wait a minute, does that make any sense? Does it really make sense that the guarantor should be guaranteed by that who's being guaranteed? You just said, I mean, it's kind of a feedback. This happens actually all the time. And I've given you some examples. One case it would be really in general not good if the guarantor's assets, after all, it's insurance. Insurance has reserves. Why does it have reserves? Because if they have to pay, they have the money to pay. That's the reason they hold assets, all right? If you have assets, fair market prices, not overvalued or anything, real market prices, solid, like gold, solid, okay? If it turns out in the state of the world where you need the reserves to pay off on losses, it turns out that asset you held has very little or no value, you're in a lot of trouble. And that's much more subtle than just saying, these are overvalued assets. They are perfectly fairly priced, but state contingent, that's the title here, contingent on when you have to pay. If you have an asset that's not worth anything in that state, you actually don't have any reserves, even though it looks like you do. And you say, well, who the heck would do that? Well, I've got a number of examples. I don't know why federal deposit insurance is still there.
I don't either, but it's okay.
It's not there.
And it's not there.
It's a misstatement, so we'll cross that one out. But the one I can point out to you is the PBGC. You're probably familiar. That's the government agency that guarantees corporate pensions. Okay? Now, what did the PBGC, by that way, that has to be signed off with 3 secretaries. Secretary of Treasury, Labor, and can you tell me the third one? But anyway, 3 secretaries have to sign off on what the policy is. They decided before 2008 to increase the equity allocation substantially for their reserves. So what equities do you think they were buying? Corporate equities. In what country? Probably a good but, maybe almost all in the United States. Who have they insured? When do they have to pay? Only when corporations can't pay. That means they're bankrupt. So do you see that, a 10-year-old, if you put it on a spreadsheet, would figure that out, okay? But do you see, that's a classic example of something that has full real value. It's not inflated value. It's just in the state where you need it, It's not there. Okay? We could talk, oh, we won't have probably time, but we'll talk about why that is. Then, of course, the other ones I put there is, just so you don't think it's all government agencies. But, a corporation who writes a CDS contract on its own debt is writing an insurance policy twice. It wrote it, it's worthless. And the same thing if you have a corporate pension plan that puts stock in the pension plan, its own stock, when the reserve is needed, it won't be there. Okay? So I won't belabor that, but that's something to think about, these feedback mechanisms, because they show up all over the place in very sensible sounding things. Because, by the way, the argument that was given for the PBGC was, in the long run, stocks, earn a higher return. They kind of made an argument like pension funds. So in order for us to be able to pay all this stuff, we better invest in stocks without thinking through what the heck they're insuring. You get it. It's like buying, insurance company that insures South Florida real estate, buying South Florida real estate is its asset to collateralize it. All right. I'm almost finished with my quick lesson, or what I hope, if I can. Oh, there it is. But it gets a little more complicated in the real world. You see this between the sovereign, because many entities buy government bonds, right? Many banks buy government bonds. In fact, they're encouraged to by their governments, especially when they can't sell the government bonds too well. So you see, that's an example of a feedback, the same kind. You're getting a guarantee from the government, and the assets of the banks they're writing a guarantee of the government. So they're guaranteeing each other. You can see that one doesn't go well with a dynamic. I think you all can figure that one out. But look here, this is like, Euroland crisis, right? Now you have multiple countries, all the same asset. So you have on the top flight, a domestic, you have the sovereign, and it's looking after its banks in Greece. And in the bottom one, you have Germany, and you have the German government looking after German banks. And some people in Germany saying, let the Greeks fail, what the heck? They got to learn a lesson or whatever. You've heard that story, right? Well, if you look at the flows here, the risk flows, you see it's a lot more complicated. Why? Because German banks wrote guarantees of Greek bonds. So the German government, looking after the German banks, are actually going to have to look after them because of the guarantees if Greece goes down. And you may even remember it got to a point where, sadly to say, financial engineering was being used by the governments to try to engineer Greece default without triggering the default protection of CDS. In other words, try to engineer so that the insurance that had been bought from the banks would not pay off. Think about that, okay? So that's where I stop. You want me to do the other or not?
Wait, what? Why don't you? Well, let me back you. Actually, I want to back you up to your third slide, I think.
Okay, let's see if I can do that.
I'm going to
That one?
truncate. Yes, this one.
Okay.
So I'm going to start with a question that I think is really hard. It's a conversation I have had with so many different government agencies. So this speaks very much to the question of, let's go back to March of 2020 when the spreads were through the roof.
Right.
And what you said is, well, they were through the roof because from the perspective of that period, there was a ton of risk exposure. And so that's the signal you're getting. But now when you take this to the government and you say, how should you assess the cost of the guarantee that you write in March 2020? And so this is actually where people start really rejecting market prices, I have to say, because they might accept when the spread is 12% that that's kind of a normal market. But I'm curious what you think about whether that 2020 price, whether you really want to use that as representative of the cost of the insurance that the government is giving, or for argument's sake, I'll say what people say to me, which is, well, it's not, because there's a distress premium in the market, and the government, that isn't indicative of the cost of the government. So I'm just kind of, it's actually a
Okay.
question, people in the room might think about it too. It's actually very challenging thing to talk
Let me
about.
just put it directly to you.
Yeah,
People say markets get goofy and you can't trust them.
yeah, that's what they
Okay.
say.
And look, first of all, let's be serious about the real world. We're talking about markets. I'm thinking of the big markets, the global equity markets, global debt markets, big currency markets, not the meme markets or the, tangential ones, the big asset stuff I was showing you with the bonds. Those are $1 trillion of equity. Who trades those markets? Who drives the prices in those markets? It's an institutional global world, even with a lot of national, sense of national climbing in. It's still global in the financial markets. It's highly global. So, and who's trading? Yeah, I don't, because I gave up on that a long time ago. But, there's some people who go and buy stocks. They have fun doing that or whatever. Do you think that's what's driving the prices? Is your picture that it's a taxi driver or a college professor or who are driving these prices? I don't think that's a good model, frankly. If you look at the world, sovereign wealth fund in Asia, they know something. And they have needs. And they transact in the market. That effect is felt around the world. And it's happening everywhere. Okay? And market prices are simply a very efficient aggregation of all that information, but it's not the average of that information. It's the weighted average. How does it get weighted? The bigger the trade, the more impact on price. Now, what makes the trade bigger for one entity than another trading in a particular market? Either that trading activity has a lot of assets, like a sovereign wealth fund, or it has very good information about not the world markets, nobody has that, but about something, maybe in Singapore or something, where they feel very confident about that, and rationally, because if they have information that's not, publicly available, they should trade on it. I mean, assume it was legal. You know what I'm saying? So that's all fits in. So the bigger the trade, it's either the more informed they believe they are, and these are professionals, doesn't mean they can't be wrong, but they're not, college professors and ribbon clerks, okay? So you've got information in the market, one that no one has, no central bank, no sovereign wealth fund. They all have pieces, but it's only the market that puts those pieces together in a way that I don't think AI and everything we're talking about could do. Maybe someday, I don't know. I just remind you of things you know, but when we talk about that kind of thing, we have to weight it by what's the likely explanation here. And I don't think it's a very good explanation to assume, oh, everybody got scared and ran off and it was blah, 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 blah. The fact that it came back, okay, is an ex post outcome. And we all know survivorship bias. If you're in a crisis, you don't know, if any of you go back to COVID and try to do it in your mind, we didn't know what the heck was going to happen. Or go back to 2008 when Lehman blew up, okay? And, Ben Bernanke and others decided it would be the end of financial world if we didn't do some pretty dramatic things. It wasn't, oh, gee, this is one of those shocks and people get, too frightened and scared and markets, they pull out of markets and it all goes away and it'll be right back. That's the people who tell that story are the survivors. It did come back. But look at history, it doesn't always come back. And those that don't survive don't tell the stories. I'm just reminding you. So I'm sorry to take so long with this, but it feels to me, if I had to put a bet, and I'm not doing this because I believe the markets have to be super efficient, it's just that they have a heck of a lot of information that no one has. And, to me, I say the null hypothesis is the market prices are probably the best estimate unless you have some very specialized information, okay? And if you do, it's only partial information. It's not the whole story. Okay, so that's my first, response to that. That the null hypothesis is that accept market prices, certainly market prices in large global equity markets, bond markets, and so forth. Yes, governments can pervert interest rates sometimes. That's what they try to do, but the government knows that. I hope. Now they can't always succeed at doing it, but they know that. So you have no, you'll know that reason, and that I don't think anyone was trying to drive prices of those bonds down. The government didn't have a policy. We're going to try to drive the the prices of corporate bonds for the major companies in the United States down during COVID. So I don't think that you could make that argument the way you could about people saying trying to keep interest rates at very low levels or something other thing. So that's my answer to you. I don't know for sure, but I'll tell you where I'll put my bet. And I already showed you structurally how fast, how much markets can change, the value of that guarantee can change for changes in asset values. So I showed you first the foundation that you would expect this to happen if you had come from Mars and studied the model but didn't know anything about the data. You would have said this is what you would have expected to happen. You didn't know it was going to come back up, but that's the state of the world where it happened to end up. Okay, did that answer it?
Yes, I won't. I mean, I think there's a more, I know what the next round would be where we're having this conversation with a policymaker. So I'll just go on and just say it, which is they're not worried about the taxi drivers making the decisions. They're worried that the financial institutions themselves, the ones that do have the capacity to make the trades, become constrained for various reasons because of regulatory capital or something else. So they feel like the players who could make the smart decisions are no longer there. So that's one aspect. And then the other aspect of the pushback is that they think that the interventions that they're going to make, the ones you're trying to price, which are basically to put out these guarantees, are going to change the equilibrium. So, I mean, the story that supports you is that the market should anticipate
very
that they're
good.
going to change the equilibrium, and that's already priced in, which is how I would then counter.
Okay.
But it's a longer conversation, which isn't easy, and Jeremy can do the other side.
The story is that you're telling, I'm sorry, but I just want to make sure I got it, because I'm burning up your time.
Yeah.
The story is that if we just step in and make people feel good, stability, okay, then the problem will go away. There will be no default. So in fact, the guarantees really aren't worth anything. Well, first of all, that assumes that the entity that's stepping in, what government is, has the power to control that. And I don't think, at least this person didn't think, that we had, for sure, enough power to keep bad things from happening as a result of COVID. I didn't know it was going to happen. Maybe you all did, and I hope you then jumped into the market and bought at these great prices. And, God bless, if that's the reason. But what I'm saying is that that's a very big assumption. And yes, under some conditions, some discussed this morning, others, that when you have a run on a bank, etc., the structure is such that if you put the guarantee on it, it stops. That works. That's not saying that that's what works when you get hit with COVID. That's a different event. And so all I'm showing you is at least my bet, or you got to disprove it to me. I don't have to prove to you that the market prices are reasonably, maybe the best estimates, but indeed, I would say you have to disprove the null hypothesis. The null hypothesis is not that the market is messed up. So that's how I would just connect it, because otherwise we'll be here all day.
No, we're not going to be, but
no, I know.
But I do want to put another question that relates to the panel earlier this morning, which is there was a lot of discussion about what should have happened in the wake of SVB. Was that a appropriate government action? How do you feel about the SVB situation?
Well, first I want to make very clear to everyone that I've never worked. I mean, I've been to the Fed. I even know people in the Fed, and I've enjoyed. But I've never worked in the Fed. I've never specialized. I'm not a banking expert. I don't know what's going on. I certainly don't have an idea of actually what's going on in terms of what's being used there. So let me just say that I want to avoid getting to my, what is it, the Peter principle? You go to your zone of incompetence or ignorance. But what I would say, it's not my place to advocate what the policies that should be done. And I particularly feel that way. This is personal because I think it endangers my ability to do what I'm doing right now. Because as soon as I take a position that this is the policy we should do, as much as I'd like to think I'm giving a completely as unbiased as possible thing, I will have an outcome I want. I'm probably going to tell the story a little differently. So both because of ignorance in part, and I don't think I should be making that decision, but even if I should, I have qualms about it because it defeats the role that I like to think I can play in bringing people to think about it. So the first thing is, what's the right thing to do? I've laid out things as best I can on this thing, effort. But the second thing I would say is probably making the value of all these contingent liabilities as transparently as possible. Shine a big light on it, a big balance sheet light of value. Don't let it be taken off the books or put in a footnote or carried on the books at book, as if that's the best estimate of value or even close to it. Okay, you see how things are changing here. So you can reject that hypothesis at almost any T level you want, okay? So transparency. Now you fairly would say, wait a minute, many of these guarantees aren't traded in the market directly. So we can't do anything about it. Baloney. You can build a model. And by the way, you can make the model transparent. So everybody out there looking at what you show will understand how you arrived at it if you want. So that if people don't like your model, they'll make the appropriate adjustments. But the idea that because it doesn't trade, that you can't put a market price on it, you have to carry it at some either arbitrary price or book value, it's just crazy. Every day, companies make decisions to acquire or do assets called capital budgeting to build businesses where the thing they're buying doesn't directly trade yet. But we're very good, and they are very good at, finding surrogates to help to get to a pretty good evaluation of what they think it will be. And that's a better number than book, or I don't know. So I don't buy into that as a reason not to be transparent. And you see, too, transparency is not just the valuation. Transparency is how the risk is changing. Remember I showed you in that second slide that the risk can go from 2 cents to 5 cents to 10 cents. Same asset, same security, you haven't traded a thing. And that changes your risk level for the next play. So one way or another, there ought to be a way to show that. And we could figure out ways to do that. So I'm not going to spend any more time. Okay. Now, I have another point I want to make because this is related to the conversation this morning, precisely on the SVB and so forth. My belief is, and you can correct me, I'm looking right at you, that my belief is that it was interest rate risk together with the circumstances that you described, but the actual driver, it was interest rate risk. The fact that they bought long bonds, they had deposits, and the long bond prices changed because interest rates changed a lot, okay? So the bank was bearing interest rate risk. Here's my question to you. Why in 2023 should banks, by that I mean banks that are functionally banks, they're doing banking functions, or the way I would say it, not they have a label bank, okay? Because we know banks do lots of different things, right? But the actual banks. Why should they be taking interest rate risk? That's not part of banking. People say, what do you mean? Interest rates are risk. Wrong. Let me tell you. The only reason for a bank to take interest rate risk is if it has superior information. It thinks it can make money by taking interest rate risk, more money than just taking the risk, because anybody can get interest rate risk. I don't have to pay a bank to take interest rate risk for me. I can get that in any number of ways, right? So the only reason I can think of them to take interest rate risk is because they think they can forecast interest rates better than the market. And they can make an alpha, is the jargon. I know of no evidence that banks are superior forecasters of interest rates. It's certainly not a skill that's needed to be a good banker. But moreover, if they have that skill, they would be crazy to use it for their loan book. They ought to set up an asset management subsidiary or even a separate whole company and get 2 and 20 on huge volume from around the world for beating the interest rate market in a huge scale market. So I just can't rationalize. Now, in some earlier time, 19th century, or even the early part of the 20th century, of course, markets weren't like that. But the interest rate swap, for one, has changed that completely. No bank has to take interest rate risk to satisfy its customers. Depositors who want short, borrowers who may want fixed. You can provide that service and not take interest rate risk. You can lay it off very efficiently in the swap market, at least as far as I know. And you know that in terms of notional amounts, that's in the hundreds of trillions. So that will take a lot of capacity. I don't know. I had assumed that banks mostly did this or chose what interest rate risk. Some have told me they don't do much of it. I don't know that. But all I can say is I see no reason for them to take interest rate risk. So I can't rationalize why the heck they were doing that. That's not what I think of the banking business. The banking business is intermediating, providing what depositors want and what borrowers want. And yes, they do need to evaluate credit because that's what they're doing when they make loans. That's a business. So it's okay to take the credit risk. The problem is, and then this would be true if we did a guarantee analysis with these slides, these models for SVB, I presume we'll find huge fall, right, in the assets. And that's because of a mismatch of interest rates, consciously done. So this was, the guarantee price didn't go down because it was interest rate versus credit risk. Because as you saw from the model, if you know Black-Scholes or anything, what matters for the valuation of the guarantee is the volatility of the asset, total volatility, not beta, not important risk or unimportant risk, just sigma. And that's the power of that model. And so all I say is if you put vol in there, the value of the guarantee is sincerely higher. So one way I would say is actions, maybe we should reconsider that. And maybe policies could be such that it says you either want to set up a separate subsidiary if you've got interest rate things, or if you're going to take interest rate risk when it really isn't part of banking, you should pay for it, whether it's capital requirements or whatever. I don't want to micro-design that. But I see no justification for the banking system that banks have to take interest rate risk.
I'm going to interrupt you just because I want to get in one more point that I know you want to make and then open it up to the audience to ask questions. And as the last thing is a bit of a switch of gears, but something else that you've been very creative in developing is what you call the functional approach to finance. And it's basically looking at what finance does, what needs to be satisfied, but not getting into the institutional details, which means not making an artificial wall between what the government does, what the private sector does, just try to find the best form for what needs to be done. And I just was hoping you would just comment a bit about that.
You're unleashing,
No, I don't want to, but
I
you're
know.
only, it's a very short, I have 2 dogs,
I'll
they're
give
very
you,
strong.
I'll give you
I'm
the
good at holding a
teaser
leash.
if you want to think of it,
Okay.
because I'll give you the teaser. Look, I've always been involved in financial innovation, both in practice as well as writing about it. And one of the things that for sure is true is that the financial system has innovated a great deal. That goes back 8 centuries if you look at it, but it's innovated enormously. The institutions that did things at one time are very different than another. And the institutions that perform a certain function in one country are often very different than the other. Okay? So the institutions are the things that change. And they are cross-sectionally different if you go across geopolitical borders, and they change over time. Okay? So if your anchor of thinking, let alone forget a regulation for the moment, just thinking, is that the institution is your unit. You're using as your unit of analysis something that's changing all the time, and you can't define something into, your unit of analysis are your axioms. You can't define you can't explain an axiom. Okay? Retirement, for example, is a function. It was a function 100 years ago. It'll be a function 100 years from now. It's a function in China, and it's a function here. Functions don't change. But the institutional way in which you perform the function change a lot. They're very different. In agrarian countries, it's a family as the institutions, and et cetera. Okay? So if you want to understand innovation and institutional change, you want to be able to predict how the world's going to change rather than having this naive view that the world isn't changing when you just look at the facts. If you use as your axioms functions, I think you'll discover things become a lot clearer. Because you can always, you go to a country you've never been in, and I'll think of old East Germany or something, and you say, wait a minute, they have no loan market. They're not allowed to lend money or something. Well, I know that function has to be performed, so I know I got to look for the institutions by which they do that. I'm trying to give you, first, the raison d'etre for thinking about it. If you want to understand and predict institutional change and to close the model, so what do I predict with the functions? The exercise is, ask yourself the following question. With a clean sheet of paper, looking at a particular function in a particular place that you want to perform, if I gave you a clean sheet of paper and let you design it any way you wanted, no constraints. It has to be feasible, but no constraints. And then I said, solve that problem, which is a well-defined problem, not an easy problem, but a well-defined one. You come up with a design. And then you look at that design, and then you look at the way it's being done now, they're likely to be different. So now you have two fixed points. Nirvana, the best you can imagine of how to solve, deliver this function now, with technology of now, with all you know now, okay? And where you are. That tells you where you are, you know where you are, and you know where you want to go. And then you map between them. And that also allows you to forecast. And now admit, it assumes that on the whole, innovation will get around to doing something that's close to optimal, or at least pretty sensible. I believe that's the case. So I admit that's an assumption. So that's the purpose of it.
You want to do your last two slides?
Pardon?
Did you want to segue into your last two slides on this?
Oh, okay, yes.
You don't need to, but
No, I want to show it to you. So,
okay.
no, look, you put me up here.
I know.
And nobody has changed a chair. I'll turn around if you want to just walk out of the room and get away. But let me just finish on this. I just want you to hear, if you start to think about it a little bit, you suddenly will find I've been doing this, and I've been applying it in things like designing retirement systems for years. And it works. It works better in practice, actually, it does in theory. But anyway, let me not go further on that. So that's where it came from, okay? Now, let me come back to issues of government and government involvement in things. And that's the slides I have at the tip here, if I can ever get to them. Come on, please. One more. Am I that incompetent? I'm pushing the green
You know
button.
what? I'm afraid that I'm so sorry.
It's not there?
It might, because that's why there was a mistake in the slides. I don't know that we can fix it right away. Could you, I'm so sorry.
All right, I'll
make
just
the
describe,
point
I'll
quickly.
just describe that.
I'm sorry.
What it is, because I think I could do it. I mean, I could do slides like, this is a graph, this is the y-axis, this is the x-axis. No, so let me explain. If I do a chart, which I've done, of the three, think of the three big things that government does that related, financial stability, monetary policy, right, and then fiscal policies. Think of those as three silos, just three things. If you look at a chart that's based on a certainty model, now, of course, I'm not suggesting that people in the government think the world is certain. I'm saying the model they use, just like using the Keynesian model with no uncertainty. So you look at it, you draw those diagrams and what they're connected, and they're basically three silos by themselves and very simple. Now bring risk in, uncertainty, and draw the new one. It's very complex. Quick one. You lower interest rates, particularly long rates. Why? You're trying to stimulate stuff. What happens? A bunch of baby boomers who are not only large in number, but large in resources, who thought they had enough saved for retirement, they haven't retired yet, suddenly see that the money they put together would not be enough to pay for the retirement they want because interest rates have tracked, the price of annuities or whatever gone to the moon. So what do they react? Do they go out and consume? No. They go out and save more because you've just trashed them. You've taken down the pension system, the DB pension system. You certainly put them in a terrible position, and you certainly haven't done any favors to insurance companies who are writing annuities. So all I want to say out of this is, time has come where we got to actually put risk and uncertainty in the structure when we think about how we use it. And one way or another, I'm not going to micromanage how you create it. One way or another, actions taken with a light on, we've got to stimulate or get more consumption or something, or we have to stabilize, okay, have to be integrated. I don't mean centralized decision making. I mean that there has to be communication to understand the consequences of a proposed policy on the other silos. And then a decision made, yeah, well, too bad for these retirees, or no, we can't do that. Or surprise, instead of getting consumption, you get more saving. So we didn't even get what we thought we were going to get. It's extreme. So that's what I really want to say. And all of this is an idea that I believe that we can do enormously good things in understanding innovation, dynamics of institutional change, understanding so many other things, and also understanding things like that are always done, that we talked a little bit about this morning. Money market funds, right? They're perfectly liquid. They're always $1, right? Except when they have to be all guaranteed. Or 7-day auction notes on 30-year bonds where the auction fails. And suddenly those biotech companies that had their money tied up to pay for drug discovery that Andrew was talking about earlier today, find themselves, instead of short-term, money, they find themselves with 30-year bonds, and they're not US government bonds, okay? I mean, we know from the analysis that people are always going to be driven to try to, skirt these things, not because they're bad, it's just the nature of trying to sell and get things done and show a higher return. And so using the functional perspective, you can often decompose why and what is being done there, and then use that to think about regulation. And finally, just to say, I am not saying it's going to be simple to do functional regulation, because that has a problem too. So the actual implementation between functional and institutional. But I would mention, as close, shadow banks. Shadow banks is hoisting the white flag for the institutional approach, because it's saying we have a whole bunch of institutions out there that aren't banks, but they're behaving just like banks, and their function in society is the same as banks, therefore we have to worry about them. So if you have functional, your own, not you personally, but the very notion of a shadow bank, I consider a prima facie case that we need to do something better. Thank you on that. Now,
Thank you. I'm just going to we can applaud in a second. I think there's room for 1 or 2 questions, and I'll let Ed, there's a question right there, Dan, or right over here. Ed, there's a question right over here. Oh, could you go back 1 slide? Back will probably work.
Backwards, I seem to be able to do.
That one or the next one?
The table.
The CDS, the CDS table. I think it's 1 forward.
I know. There, that
Yeah.
one.
So I think that, I really thought it was an excellent slide to really tie in basically the implied volatility of all these, the put prices essentially really followed the theory well that credit spreads pretty much tracked it exactly through this COVID period. And really, but my question is on the topic of government and, these companies, I think they're all systemically important in the economy, and 2, 3, 4, and 5 have been backstopped by the government at some point, in one way or another, either in the financial crisis. And I was wondering if you could comment on, which types of corporate liabilities the government should think about, make sense to backstop, and which ones maybe not. And I think about, for example, General Electric, basically, being one example where, commercial paper and that needed to be backstopped. But now in a different sense, for example, a corporate pension liability, if rates were to rise, even though the funding status looks good because of the actuarial gain from rising rates in 22, if rates were to come back down, it could really be underfunded, and so that would be an example of maybe something that could have been anticipated and they shouldn't backstop. But pre-COVID, the government basically essentially bailed out UPS and other corporate pensions, and so I think it's a really great topic, and just wanted to hear what you think about kind of corporate liabilities and where the government should go.
First of all, this is a very important topic, and it can't be done at 50,000 feet. We can talk about it at 50,000 feet. Every case needs to be analyzed seriously on the basis of that case. I won't say there's a blanket, here it is, I wrote it on the back of an envelope, now I'm going to go back to work. Okay, so the first point is every case will be different, even for the same sets of companies. Okay, there has to be reasons why you do something. I happen to believe that Ben Bernanke had no choice but to guarantee the money market funds, given the condition that things were in at the time when he was faced with that. I don't think any of us on a weekend getting a phone call that says, by the way, Monday morning, one of the biggest money market funds is going to break the buck. And secondly, they're going to announce, that's the first announcement. The second announcement is they're going to exercise their right to not pay out on exercise, but rather someday pay out in kind, things like commercial paper and so forth. And you can imagine what that does with people who don't understand it, who can go to their computers and push to every one of these mutual funds, to redeem. And then you're going to be sitting there, whether it's Fidelity, and saying, am I going to redeem if I have to? You bet you are if you're not, because you don't want to lose the company. So I don't think he had a choice of taking that risk. That's my opinion. That's not okay? And so I can't say that was a bad thing to do. I think it's the end of the circumstance. Now, what should be done is to consider the circumstance in the first place, not in the middle of a crisis, but to understand that either you're going to pay for these things or you're not. And if you're not, then you do it, because that's the only way you can do it. I think if you back yourself into the corner, and you saw the slide I showed you between Germany and Greece and so forth, in the real world, you probably have very few choices when you get to the actual time. So it all has to be done in my view, by systematic analysis design in the 21st century, and not dealing with 20th century institutional designs to do it.
Okay. Great. Well, believe it or not, you ended on time.
Wow.
Let's
a record
thank
for
Bob
me.
very much.
Thank you.
Thank you so much. Okay. So we really just have 5 minutes before the next panel starts. Thanks.